It also comes down to understanding that, back to our example of the 6% credit card, the 6% line of credit, the 6% car loan, and the 6% mortgage. Let's take a look at that for a moment. Let's say, as an example, you ran up $1,000 balance on your credit card, and I'll do this interactively with you. If you run up a $1,000 balance on your credit card and you pay it off in full before the end of the month, how much interest do you pay, CJ?
Zero.
That's right, zero. Now, sometimes I mess with people and I say, "Are you sure?" And they find themselves pausing and scrambling, like, "Well, wait a minute, maybe this is a trick question." Okay. Yes, the answer is zero. But the point is, if that's true, and it is, then did the interest rate that was currently associated with that credit card actually matter at all? No, because it is not so much about the interest rate, but how the interest is calculated, how the finance charges are assessed, and how when the payments are applied. So because of the way that loan works or how it's structured, you actually end up paying 0%, which means whether or not it would have been a 0% interest rate or 29.99%, you actually paid zero, irrespective of the interest rate. Important principle to understand. Now let's take a line of credit. Again, could be a personal line of credit, could be a business line of credit, could be a home equity line of credit. Let's say you borrow that same $1,000, CJ, on the 1st, and you pay it off on the 17th or the 21st or the 24th or whatever the case would be. Do you pay zero interest? No. You actually end up paying finance charges predicated on average daily balance. Well, what does that really mean in practical terms? What that really means is that you're no longer paying 1,000 or 6% on $1,000. You're paying the equivalent of maybe 2 or 3% on the $1,000. So what that means again is, did the interest rate, or was the interest rate the most operative factor in that loan? No, it's how the interest is calculated, how the finance charges in that case are assessed because of how and when the payment is applied. So again, the interest volume, or the true debt service cost, had only something to do with the interest rate and more so to do with the type of loan. Very important concept to understand. Now let's take a car loan. And this addresses one of the questions you told me you had before, where people want to relate that, oh, doesn't a mortgage work just like a car loan? It's simple interest, et cetera. Well, again, I don't use the vernacular of simple versus compounded because there's some variables there that could make that different. But it is open versus closed end, but it's also the type of amortization that the bank decides to deploy. So let's look at an average car loan. Now, I'm not talking about some super car that's a $500,000 that you're financing for 15 years and have some crazy balloon at the end. I'm talking about a traditional car loan that applies to 80 or 90% of cars in America, where it's probably going to be for 4, 5, 6 years, as an example, right? Now, years ago, we never even had 5 or 6 year loans, right? They were all 2, 3, 4 year loans. But because of the price of cars, et cetera, that's become a necessity, interest rates, et cetera. But let's say on a $500 car loan, which would be pretty inexpensive, quite frankly, in this day and age, and $100 goes to interest and $400 goes to principal. Well, guess what happens month 2? The exact same. Month 3, month 12, month 24, month 30, all exactly the same. Well, why is that? Well, because as a general rule, cars depreciate. So if cars worked like other loans, i.e. mortgages, almost every car on the road in America that had a loan on it would be upside down. That'd be a huge problem. So guess what loan does not work that way? A fully amortized loan that does not work. We already explained the disparity between credit cards, open-ended loans, lines of credit, et cetera. But on a fixed, fully amortized loan, look at how a mortgage works differently than a car loan. Yes, it is a simple interest calculation, essentially, but it's also structured in a way where the bell curve means you're paying the vast majority of that interest in the first third of the loan, specifically the first 7 years in a 30-year loan. So if anybody was to take their statement, let's say they had the loan for 1 month or 1 year versus having it 8 years or 10 years, they would see that that interest volume calculation would change significantly. Now, we all know this instinctively and inherently, but we don't actually put a paper and pencil to it and understand the real math. So here's an example. I'm not somebody that would, even though I've been involved in the mortgage business for 25 plus years, I would never dissuade somebody from considering the possibility of a refinance if it made sense mathematically or circumstantially. If you're pulling money out to do home improvement, appreciate the value of your property, or to consolidate debt to reduce your blended or weighted interest, there's plenty of arguments for it. But just simply refinancing for rate reduction is something you have to take pause and really consider the factors. Now, yes, if you're 4, 5, 6 years into a 30-year loan, could you reset it to 24 or 23 or 25 years? Yes, technically you could, although there are a lot of banks that don't necessarily offer that. They're pretty cut and dry. 15-year, 30-year, maybe a maybe a 20-year on occasion or 10-year or something. But 74% of individuals that have 23 years or more left go back to 30 years. Now, whose advantage is it to add 4, 5, 6, 8 years to the length of your loan? Here's a newsflash. It's not you. It's definitely the banks. And of course, there are costs involved. In certain states, i.e., California, Texas, Florida, New York, there's about 5 or 6 states that are particularly expensive. One, it's a tax issue. Number two, it's a supply and demand issue because they have a lot of it, so they can charge more for it. But regardless, it's a pretty expensive process. Even if the person doing the loan for you charged little to nothing, there are doc stamps, there's intangibles, there's what we call promulgated rates on title, et cetera. There's a lot of cost involved. It could be 2%, 3%, it could be 4 or 5%, but there's a lot. So on a $200,000, $300,000, $400,000 loan, you might be adding $8, $10, $12, $15,000 to the size of the loan. Again, whose advantage is it to you increase the size of your indebtedness? You or the bank? Not you. So the whole point is, and the third answer is, even if you reduce your note rate, let's say somebody went from 8% to 6, or a few years ago went from 6 to 4, or even 3 or 2 or 3, the amount of interest volume, i.e., again, the percentage of interest that's being applied to the payment actually goes up, not down, because you're resetting the clock back to the front end of that schedule on that amortization curve, right? So these are all factors. So if you're going to extend the length of your loan 4, 5, 6, 8 years, you're going to increase the amount of that debt, 6, 8, 10, $12,000, and you're going to reset the clock, which means even though you might have lowered your note rate, you might have actually increased the amount of interest volume you're paying per payment. None of those things are good for the consumer. Now, we have strategies to mitigate that, which is exactly why we developed our financial GPS platform to help mitigate that. And then ultimately, again, I'm going to reinforce, CJ, it's all about effective interest rate, just like it's about effective tax rate. It's about effective interest rate. How much are you actually paying when it's all said and done? So I know there's a whole deeper conversation and rabbit hole that we can go down there, but I hope that answers at least those couple of initial questions there.
No, that's perfect. I actually was got caught up on what you had said earlier about the
Mm-hmm.
effective interest rate, and in talking about interest cancellation. Let's do this. Let's ask what this one person said, okay? And in
Sure.
regards to, and you don't have to answer it, right? But maybe answer it in a conceptual way, right? So that
Okay.
we have a fuller understanding of what's going on here. So if you place, let's say, $5,000 into your credit card, and you pay that balance off, right? And you were at a $10,000 limit, let's say,
Mm-hmm.
and they immediately drop your limit. Okay, we're in a volatile environment in some places. They drop your limit to 5K, so that you can't pay. Perhaps you were paying some bills and you were relying on your credit card there. Um, what happens when that scenario takes place? How should we think about that? Like, how should we think about the credit card? How should we think about interest rates if that scenario takes place? Because that's a real thing.
Yeah.
People
Well,
that are having like massive, limits, they're getting cut down to whatever they paid in. And they're like,
mhm.
whoa, what's going on?
Well, my first response to that would be, how does that feel or what? Well, it sucks. So first of all, we'll say that that's not great for the consumer. Okay.
Right.
So I'll also add that unfortunately there are things that none of us have any control of. Right. I sadly don't have control. People often don't have control of whether they're going to have a heart attack tomorrow. We don't have control whether somebody's going to run an intersection and T-bone us either. There are variables we just simply can't control in life. Now, is this overly common? No, it's not overly common. And generally, respectfully, there are probably other considerations there that are dictating that. It's not just random and haphazard. Every once in a while, it is across the board. A certain bank is trying to mitigate their exposure, and that's a more complicated conversation, but they're trying to mitigate their vulnerability or exposure. Okay.